Hi everyone, my name is Lucy and I'm going to be part 2 of a tutorial based on chapter 23. Starting with question 2. Question 2a states that we have to list the cost of inflation and discuss one of our choice. Inflation is the general increase in the price level of goods and services which results in a decline in the purchasing power of money. Very important to always remember this definition. So we have the following as the cost of inflation: shoe leather costs, tax distortions, money illusions, and inflation variability. I am not going to discuss only one, but I'm going to discuss all of them. With regard to shoe leather costs, since money loses value during inflation, people economize on their holdings of money. And then they hold mutual fund shares, equities, or bonds that offer high rates of return of money. But to carry out the transaction, they need money. Hence, they must engage in endless series of financial transactions, transferring funds from liquid account to liquid account to make payments. It takes time, effort, and often involves some monetary cost. Inflation distorts prices. Business people make decisions on the basis of manifolds, for example, revenue, cost of inputs, dollars of profits, and so on. To make good decisions, business people must have accurate information. Because of inflation, prices tend to change more frequently, and then if business managers misread prices, they are apt to misallocate resources and capital. What do we mean by resource misallocation? Resource misallocation refers to producing too much or too little because of misreading the true relative price of the good being produced. It reduces the efficiency of production and the profit earned by firms. So I am going to read out the summary of each cost of inflation, starting with shoe leather cost. This refers to the time and effort that people spend trying to counter the effects of high inflation, which leads to high interest rates. They do this by trying to hold less money and have to make additional trips to the bank. Tax distortions. These are taxes that do not adjust for inflation. Taxes on capital gains are typically based on a change in price in dollars of the asset because the time it was purchased and the time it was sold, not the inflation adjusted increase. So essentially, the higher the inflation, the tax, inflation also increases the tax rate paid on interest income. Money illusion. This is the notion that people have tendencies to view the wealth or income in nominal terms and not in real terms. This means that people don't take into account inflation, believing the rent they hold has the same value as last year. And the last one is inflation variability. This means that financial assets such as bonds that promise to make a fixed normal payment in the future becomes riskier. When inflation is constant, the real value of bond after a certain number of years is known. With varying inflation, the value of the... Moving on to question 2b. Suppose you have a mortgage of 50,000 rand. Expected inflation is pi to the power of e and the capital gain tax is 30%. Consider two cases. One, it's pi to the power of e is equal to 0 and pi to the power of e is equal to 12. Calculate the effective tax rate on the sale in 7 years. Okay, it's going to be 0.3, which is the 30%, multiplied by 50,000 into 1 plus 0, which is given to the power of 7 years minus 50,000, which is the mortgage, divided by the mortgage of 50,000 into 1 plus the 0, all to the power of 7. And if you put this on your calculator, you should be able to get 0. Moving on to 2, which is pi to the power of e equals 12. The effective rate is going to be 30%, which is 0.3, multiplied by the mortgage bond of 50,000 rand into 1 plus 12 to the power of 7 minus 50,000 all over 50,000 into 1 plus 12 to the power of 7. And the effective rate is going to be 16.43%. Moving on to question 3. List the benefits of inflation and discuss one of your choice. The benefits of inflation are as follows. We have seigniorage, which is money creation, the ultimate source of inflation. It may be counted as positive revenue for a government when the money it creates is worth more than the cost to produce the money. The other benefit of this is that the government does not have to rely on taxation to fund their expenditures, so it lowers taxation. The option of negative real interest rates. An economy with high interest rates can counter economic shocks because it has room to lower interest rates to fight a recession. A country with lower average interest rate does not have the same amount of room to maneuver. Money illusion in facilitating real wage adjustments. When there is a positive inflation rate, firms or employers are able to use this to their advantage. The inflation allows for real wage reduction, whilst the workers who look at their income in the normal terms do not recognize that taking inflation into account, their real wage is actually decreasing. So inflation allows for this negative real wage adjustment. This is the end of your tutorial based on chapter 23, and this is also the last tutorial for the semester. I'd like to wish you guys all the best with the last test that you're writing also, and also for the rest of your academic year. I hope you all do very well and do pass this module.